concepts and principles, accounting concepts and principles, and then we will discuss about accounting errors, and then we'll discuss about um, golden rules of accounting, so that we are prepared to pass the journal entries, how the journal entries will be recorded in the books, right? So that would be the basis we will be setting for tomorrow class, wherein we will follow or we will practice, many more journal entries. Okay. Right away, let me share my screen. Uh, can you see my screen?
Yes, sir.
Okay, cool. Okay, right. Let me write down the accounting concepts and principles. So one question before we go, right? So what is the importance of accounting concepts? Um, why do we require those? Any comments from your side? Anybody of you? Yeah.
To get the clear
So
picture of financial statement, all those things.
to get the clear picture, yes. Any other? So just think of a cricket match, right? So for playing cricket, we will be having some rules that all international matches will follow, right? So whenever similar like that, I think whenever we prepare the financial statements, we should follow these accounting concepts and principles. So that is, I think that is the foundation. These are the foundation on which we prepare the financial statements. Okay, so these are, I think, if you understand this, I think, and also with the examples, we are good to go. And then, prepare the journal entries. Okay, starts with, I think, let me just put the business entity. What does the business entity concept will tell us is like R. Narayan Murthy is different from Infosys, right? And then they are both are not same, right? I think, he, even though he is the owner, he is different and the entity is different. Similar to Ambani, he might be the shareholder. If he draws some money from the Reliance, it will be accounted. So he cannot say that this is my money as per the accounting concepts. So when I'm saying this, all these accounting concepts, right? For the interview purpose, we need to by heart the definitions, and also we always need to keep in an example during the interview process. They will just ask us the business entity concept, right? In that case, we need to prepare these definitions, and also in the later classes, I'm definitely going to call all of these. Maybe um, if you remember, maybe I would ask you to study these when I'm saying now. I will also write the definitions over there. I think these are the concepts we recall throughout our 30-day period. Okay. So the business entity, what they're saying is that here the business is the business and its owner are treated as separate entities for accounting purposes. In reality, we all know that that is different. But for accounting purpose and for the financial reporting purpose, business and its owner are treated as separate entities for entities. So one more example is saying like, okay, for example, me myself, I'm working on in an IT company and want to start a tea shop called a tea corner, I would say. Um, Few days, I think, I invested 1 lakh from my savings. Somebody is writing mine screen. Praveen, bro.
Yes.
I think in my screen, I think somebody is writing Raja Kumar.
Okay.
Can
Maybe
you?
okay. It's a transcript. I'll off that. Okay.
Yeah, sure. Thanks, bro.
You can erase it out.
Um, where can I? It's gone. Thank you. Right. I started the tea corner with the 1 lakh from my savings. And after some time, if I go to the tea corner and ask 5,000 for my expenses, definitely the accountant says, right, you will not be able to withdraw without a proper accounting for that. So from this, we'll always remember that the business is different from a owner with respect to accounting. Okay, so that is about the business entity concept. And then the next one is the money measurement. So what is money measurement is like, okay, so we will only record the transaction if it is measurable in money concept, in the money. For example, like, okay, I have hundred of hundreds of employees in my company. Of course, they are a value to me, but I will not account that in a business, right? So the money measurement concept means only transactions measurable in money are recorded. I have a question now. So, for example, I live in a border. I think not definitely the Pakistan border. I will live to the Europe border, I would say. So, what I've done is like I sold cricket bats of 100 rupees inside my country, and also I sold cricket bats for 100 euros, right? So, what is my total revenue? Normally, I think, if there is no uniform monetary unit, then I would say like, okay, it is 200, right? But actually, because your business is established in India, all your transactions needs to be converted into rupees, which is our reporting currency, right? So in that case, we need to convert whatever the cricket bats you sold outside of your country, that is Europe, 100 euros. We need to convert that into the rupees. So then that gives a clear picture for us whenever we see the financial statements. So here, one is definitely should be money measure, and the other one is we should have uniform monetary unit, which is a reporting currency. One more thing came into my mind now. For example, a land has been purchased 50 years ago for 10 lakhs, and now again I purchased one more piece of land for 30 lakhs, 10 and 30. So this is 10 years ago, and now this is now. So both of them we are going to record in our books as 40 lakhs only. Just because your piece of land which was purchased 10 years ago got increased, right? You will not show that as that incremental amount. So in this way, I think what we need to remember is accounting doesn't give a true and fair view of the affairs of the business because we always go with the historical concept, right? So that is about the business entity and money measurement concept. Any questions till now before we go into the other concepts, which is the most important concept, going concern. I hope there are nobody's asking the questions. I feel that there are no doubts. Okay. The going concern. So whenever I think accountant always maintains the books of accounts of a company, thinking that the business is assumed to continue for the foreseeable future. What is foreseeable future? That is for infinite period. So he will never think that the business is going to close tomorrow until unless there is an insolvency procedure against that business, and we have a court order that okay, your company needs to be closed within an year, right? So in that case, how the accounting treatment is going to change, that is something that we need to understand now, right? So first, the definition is the business is assumed to continue for the foreseeable future. Okay, small call, right? So in this case, for example, in the same tea business that I have started, I purchased a tea machine. So normally a machine is a fixed asset, and we will not expense it out in the same year because that is going to give me a profit for another 10 years, right? So that is why whenever I purchase the machine, which is the fixed cost, for example, 10,000, I'm going to record this in my books at 10,000 rupees, but the yearly expense would be based on the depreciation method that I'm going to choose. Maybe I would say like, okay, by 5 years or 10 years, and 2,000 is my expense. But if 2,000 is my expense, I'm going to recognize that in my books of accounts. But if the company is going to close in the next 1 year, we are going to account this for at NRV, which is the net realizable value. So would be like, for example, if I am the third year of the purchase of the machine, we are going to reduce 3 into 2,000, which is 6,000. From the 10,000 to 4,000 is your I think whatever the balance is there after would say book value of the asset. We will not record this at the book value also. We will see in the market how much our machine can be sold. So that is the value at which we are going to record in our books of accounts if the accountant feels that the business is going to close very soon. Okay, so that means accounting assumes the business will continue operating for infinite period. Okay, that is about the going concern. And then fourth one is a cost concept. It is just as I mentioned, right? The tea machine that I purchased for 10,000 rupees, even though if it is now worth 90,000 in the market or 5,000 in the market, I always keep at the historical cost only. Of course, I'm going to reduce the depreciation from it, but I will record at the historical cost only. That is the purchase cost. So what is the cost concept is saying? Assets are recorded at their original purchase cost. So this is same, like even if for land, there is no depreciation, right? The land, even the land has been increased significantly. We will still keep them in our balance sheet at the original purchase cost only. Only when we sold them, then we are going to recognize the profit out of it, right? So that is very simple, the cost concept. The cost concept record assets at cost, not at the estimated value. So that is the funda. Next one is the dual aspect concept, which is very important, based on which we are going to prepare our financial statements and also prepare journal entries, all that stuff, right? So what is dual aspect concept? Is like, okay, whenever a transaction happens, it should have two effects, right? Both the debit and the credit, and the assets equal to liabilities plus equity. So this is the accounting equation that we should follow as an accountant, and we need to keep in mind the equation: asset equal to liabilities plus equity if it is a public traded company or private limited company. But for small proprietorship firms, we can call that as capital, right? So an example, um, for example, the same example, I started my business with 1 lakh rupees or 10,000 rupees, right? So what does business will do? Like, one is the capital is going to increase. At the same time, for the business, the cash is going to increase. And you can see like cash is an asset, right? And then is equal to capital always. So any transaction if you take, that will be having a two effects. That's why I think, there is a single entry bookkeeping also. I think now that is nobody follows in our accounting. It is always a double entry bookkeeping, right? So the funda is dual aspect is, we can say every debit has a credit, and also we can also write every transaction has two effects. Okay. So yeah. So are you able to following me? Am I telling something that you're not able to understand? Is everything is good, right? Till now?
Yes, sir.
Right. Good, good. Okay, then comes the most important concept, which is accrual. So, and this is the most, even if I interview somebody, like, I'm going to ask this question: what is accrual concept, right? So let's write the definition first, which is the income or the revenue and expenses are recorded when earned or incurred, not when received, not when cash or bank, what, not when cash received or paid. Okay. So what does this mean? For example, two things here I want to explain. Maybe first I will start with, the periodic cost, which are like, okay, I joined a company. I'm working as an employee for a month, which is for the May month. I worked throughout that May month, but I received the salary in the next month, that is in June. Maybe I will say like, okay, I worked for the full June month, but I received the salary in July month. So according to accrual concept, when are we going to record the salary in the books of accounts? Is it June or in July? Anybody? You can unmute and say. I think it should be, the class should be interactive so that, okay, you're following me or not. I think, that would give me a clear idea, right? So, and the questions I'm going to ask is also is very easy. For now, I think we are still in accounting concepts. So maybe I will call Girija Dash. Can you tell me when we are going to record the expense, either in June or in July?
For the month of May, it would be June.
No, for example, you have worked in a company for a June month, right? And you're going to get a salary in July. So that's what, when
It
are
will
you
be
going
June,
to?
sir.
It will be in June. Good. Right. So it's always like that. Um, for example, opened a store of a cricket bats, and one customer came to me and he wants the 10 bats from my store. I sold him, I given him the 10 bats, and he said, I'm going to pay you next month, right? So in this case, because I already have made a transaction and I earned the money, but still not get the money, right? I'm going to record my sales for sure in the current month itself, right? So that's what the accrual concept is saying. It's not when well you receive the cash. It's not when whether you paid the cash, right? Whether the transaction happened, whether the ownership has been transferred, that's more clear with respect to the accrual, the concept. So the other, I think, the mm, would say like in this case, can I write what is my revenue? Whenever, for example, in a particular period, in a June month, if I want to know what is my revenue, this is one side of the issue. Can I write something called cash, receivables, and any other consideration that I'm going to get for making a sale, right? It's not that, okay, they will only pay me cash. They can write me a land, they can give me a car as a consideration for the goods that I have sold, right? So in another way, I can also see like, okay, what is the cash received in the current month, and what are the receivables I'm going to get from the current month sales, and also the other consideration that I'm going to get. So these three would become, equal to my revenue. It is not only the cash according to the accrual concept, but obviously we know that there are two types of accounting systems, which is cash accounting system, and the another one is accrual, right? So in the cash, you're right, the revenue is always equal to cash. Similar to same, the expense is always equal to revenue is always equal to cash received. And the expense is always equal to cash paid. Right? So what is actually the major difference we'll see in between the cash accounting system versus accrual accounting system? What will happen? So if you follow according to the cash accounting system or the accrual, so what would be the difference, right? So it is the profit you are going to book in your company is going to change based on the accounting system that you are following. Let's see a small example. Why I'm want to spend a little bit more time here because this is more important, right? That's the reason. Okay, so let's just a simple P&L account. So here profit, here loss or expense, whatever, income or expense. Let's go. Right, another way, I think, for example, I purchased cricket bats. Let's go purchase cricket for 10 quantity, 100 rupees, which is 1,000 rupees you purchase, but you paid, cash paid is only 700 for now, 300 you say that I will pay later. And then you made the sale of that cricket bats. 10 you sold for 150 rupees. And you're going to make sale of this, but what you are received, cash received is only 900, and um and also like, okay, you paid the rent in cash of 200 rupees. Okay, so in accrual accounting, simple, right? What is your income? Is the sale which you have made 1,500. What is your expense? 1,000 rupees. And then rent you paid 200. And then your profit is this 300 rupees. Let's put that. And this is cash. So in cash account, because you have only received 900 and the cash you have paid for purchasing those ticket bats 700 and then rent paid in cash, that comes in both, right? So your profit is less. So that's the way, based on the accounting system that you follow, uh, the the profit that we are going to book is going to be different. So the simple equation is the revenue minus expense equal to profit according to the accrual system. Receipts minus payments equal to profit in cash accounting system. Okay, so simple. I hope you understand. Simply, we can say record when incurred, not when paid. A simple language definition. Whenever someone asks you what is accrual, we just record when incurred, not when paid. Okay, that is all about the accrual concept. Let's go to the next one, matching concept. So before matching concept, I would like to tell about the accounting period concept, right? So, so why accounting period is defined? Always, I mentioned earlier that as per going concern accountant, always think that the business is going to run indefinitely, right? Why the accounting period is important is that you should know, right, how much profit you are making for a specific period as an individual. But when it comes to tax authorities, when it comes to investors, right, they should know what a company is generating as a profit or loss in an accounting period, right? Based on which I think they were going to get dividends or they were going to like, okay, um, you, you're going to compare your last year profit and loss with your current year's P&L, right? So these are all the reasons why, which like, okay, the Companies Act and also the accounting standards, they define there should be a specific period during which the companies need to report their financial reports to an MCA, which is the Ministry of Corporate Affairs. That is the site we have for, as per the Companies Act. We need to, all the companies needs to upload their financials into those sites. And also tax, you need to pay based on your yearly income, right? So that is the reason, like, okay, we have a specific period, um, right? And also you need to, if you compare this with your accrual concept, right? If you're preparing a balance sheet or profit and loss account for a month, whatever the sales you made in the during the month, and for that, if you receive the money afterwards, after the month, right, you're going to recognize the sales in the current month only, right? I think you should have a cutoff period, um, through which you record your profit or the expense, right? Um, so one example related to again accrual concept and the accounting period concept is like, for example, I have joined an institute as a tutor, and that institution is already paid me salary. I joined, this is June month, right? June month. Um, I've joined May 31st. I have received advance salary of 10,000 on 31st May. But for the work that I'm going to do for June, I'm going to teach the classes in June only, not in May. So in this case, two things, right? When are you going to recognize expense? Obviously, when you when the business incurred that expense, right? That is obviously in June only. So June only you recognize the expense. But the money that you paid to the tutor, to me, so what you're going to recognize, right? That is an advance salary paid to an employee, right? So when you that is called a prepaid expense, right? So the entry would be prepaid expense, right? So the prepaid expense will always be recognized as an asset. What you paid is cash. Prepaid expense to cash is in month. In June, once you incur that expense, you're going to recognize um, like salary of a tutor is debit to the prepaid expense. You just reverse that reverse that expense, prepaid expense, right? So obviously the prepaid expense and prepaid expense is going to cancel, and then salary is your expense and the cash is going to go away, obvious reason. So for example, we are going to prepare the financial statement for quarter, not per month. Is there a need for me to create two types of journal entries? No need, right? This is all in one quarter, May, June, July, or April, May, June. April, May, June is the first quarter, right? So in that quarter, both the prepaid, the advance salary part of that quarter, and again, the expenditure is also part of the quarter. Even though I put these entries, my financial statements is not going to change because I'm going to reverse that in the next month itself. But if this happens at the end of the quarter, obviously you're going to recognize whatever the advance money you paid to the tutor as an asset, and that is going to we are going to show in our balance sheet. Little bit tricky. No need to panic. We are going to have more sessions, and like okay, we are going to explain these all additional and adjusting entries that we are going to pass after the trial balance finalized, are like okay, we are going to discuss this in detail in later classes. So that's where like okay, accounting period concept is like okay, we follow calendar year. That is something that you need to remember, which is April to March, right? But for all the publicly listed companies, which needs to send their quarterly financials to the stock market, right? Because obviously you might know. So and based on the quarter results, your stock price is going to change, right? That is the requirement from the SEBI, that you need to provide your financials on quarterly basis. If it is not listed, there is no need to prepare the quarterly financials. Otherwise, your management requires. If the management requires only, we'll prepare the quarterly financials. Otherwise, we'll prepare only one financial statement for full calendar year. That is for income tax purposes. Right? So again, the matching concept is also dependent on both accounting period concept and also the accrual concept. Right? So what is matching concept says is expenses should be matched with the revenue they generate. So normally, in expenses, right, we have two types of expenses, which is like okay, direct expenses and indirect expenses. We have a different names for it, like okay, in costing they call it variable versus fixed cost, right? So what is direct expenses is these direct expenses is going to increase if your sales is going to increase. Direct expenses for the next period is going to decrease if the sales are going to decrease. That means these direct expenses we are going to spend only if there is a sale happen. Example, again, the same example of cricket bats, particular one, rate, amount, right? Purchase. I purchased cricket bats. So how many quantity? 100. Rate, the rate 10. So 1,000 rupees I have purchased. I have made the sales of same the cricket bats, but only sold 70. But I sold with for 25 rupees. I made 1750. Now again the shop rent I paid 500. So in this case, what is direct expense and what is indirect expense? Can anybody can tell me? Rahul, can you tell? Even if it is wrong, no worries. Like okay, we are all here to learn, right? You're in mute.
Hello.
Yeah,
Direct expenses the purchase with a debt.
yeah,
Indirect expenses is top rent.
very good. So what is the profit for this period? Um, Muruga Perumal.
250.
How much? 250.
Yes, 250.
So what you have done, like this you have done?
Yes.
Okay. So one thing, you're not entirely correct, but we will learn now, right? So I purchased 100 bags here, but I sold only 70. I still have 30 bags with me, right? So what is matching concept is saying expenses should be matched with the revenue they generate. So here I have to expense the purchase of the cricket bats only for quantity of 70, right? So do you ever heard the concept of cost of goods sold? Um, are like, okay, materials consumed, we always going to reduce the closing stock, less less closing stock. Always. This is a fundamental rule. So what I have is minus 30. Closing stock is always, I mentioned, always valued at cost or NRV, whichever is lower, which is 10 rupees, 300. My profit is 1 second. My profit here is 550. That is what the matching concept is telling. And it is very evident, right? The closing stock needs to be reduced from the purchase. If the opening stack if we have the opening stack, we will add the opening stack. Do you understand, Rahul, now? The difference?
Yes, sir.
Cool. Good. So it is obviously right. Each and every expense, right? We will not be able to tie it out with the revenue. For example, shop rent. It doesn't have to do anything with the sales that you are going to make. So this kind of expenses we call indirect expenses that is bound by the period. So like for example, shop rent for the period of March I paid in April, but still I'm going to expense that in the March month itself, right? Um, right. So and also like I told like okay, all the fixed assets we are going to depreciate for 5 years based on its useful life, right? Why are we doing that? Anybody have any idea? The reason we do the depreciation is that we know that from that mission, we're going to raise our revenue for the next 5 years. The fixed asset is going to work for us that has the useful life of 5 years. That is why we are going to recognize the total 10,000 that of the fixed asset in the next 5 years, 2,000 per year. That is follows the matching concept only. So in the interview, they're going to ask, they give you this example. So on what concept it has been, the fixed asset has been depreciating. So I think, we need to mention the matching concept. Make sense till now? Okay, so I think we have little bit time. I will just take consistency concept, and then we have conservatism, and the last one is materiality. So these are the concepts we still have. Okay, what is consistency? Again, if anybody of you know, like, okay, how the closing stock being valued. For example, in the beginning of the year, I already have 10 t-shirts with me. During the year, I purchased 50, but I sold only 40. I still have 60 minus 40, 20, right? Um, Opening, purchase, sold, and closing. So the opening stock you have purchased in the last year at 10 rupees, but during the year, you have purchased it for 15, and whatever sold doesn't matter. Now, what is the closing stock value? Because you will not be able to say it, right? What is the 40 quantity that you sold? Whether it is from the current year purchase or from the opening t-shirts, right? We don't know, right? That's the reason, like, okay, if in accounting, in accounting standards, they mentioned different concept we have to value the closing stock. FIFO method, LIFO method, and remaining so many are there. That is not relevant for now. We will discuss remaining about in the later classes. So now these are both are valid accounting concepts. You can choose anything. Now I want to choose FIFO. What is FIFO means? First in, first out. So whatever the first purchased has been sold out. That's what the concept of FIFO means. That means 10 opening stock is already been sold, right? So whatever the closing is, 20 is part of your current year purchase. In that case, my valuation is 300. What if my manager come and say that, okay, from this year onwards, we'll follow the LIFO, right? Is that possible? If I follow the LIFO, that is the last in, first out. That means I sold out of 50, I sold first 40. I still have 10. That is 10 into 15 and 10 into 10, which is the opening stock. So how much? 150 and 100, right? So then my closing stock value is 250, right? So in this case, right, either you follow FIFO method or the LIFO method, but you need to follow it consistently for every year. If you follow one method in this year, you must follow the same method for the next year as well. Otherwise, your is going to change, obviously, because of the closing stock, right? Understand about the consistency concept? The same, like we for the depreciation as well. We have so many methods. SLM method, which is straight line method, and then WDV, written down value method. So for the fixed asset, right? I think we will follow only one method consistently. That's what the consistency concept says. The definition of the consistency concept, same accounting method should be used every year. Same accounting concept or the accounting method should be used every year, right? So conservatism and materiality, I think, it's very simple. Conservatism is like, and also called prudence, recognize losses early, but not anticipated profits. So let me write down this conservatism. Recognize losses early, but not anticipated profits. I think I have told you one example during our demo class that, okay, we have a lawsuit that we were going to have a foreseeable expense after that lawsuit implements, right? So that's called a provision, right? Or the contingent liability that we are going to call it. So that's why I think, if you feel that there should be some losses is going to happen, that we need to recognize or you expense it out in the current period itself. And also like, oh my God. So if I am a business owner, think that, okay, from the stock market, I'm going to get 1 lakh profit next year. Shall I record those profit? Not right. So it is conservatism prudence is always like, okay, if the loss is going to get in the next year, then recognize that in the current year itself. If the loss is there, if the profit is there next year, don't record it. Right? That is the conservatism. So materiality concept is very simple. Only significant information should receive, or only significant information needs to be disclosed in the financial statement. Receive special attention. Significant information received. Right. For example, in offices, right, we purchase staplers. You purchase small papers. You will not record all those with their names, right? You are going to put everything under printing and stationery. You will not give much importance to each and every account, right? So only during using the materiality concept, we only focus on items that influence the decisions. Otherwise, we are going to put them under the miscellaneous expense. We are no need to keep it with your original account, right? So one concept I want to say here, like, okay, in the tea business, right? I purchased the machines and also I purchased stapler. You know that machine is also being used for 5 years, and also staplers, if not continuously used, can be used for a couple of years, right? Do we recognize the stapler as an asset? No, because the value of the stapler is very less. That's the reason we are going to expense it out under printing and stationery. We will not recognize that as an asset in our balance sheet. Right? Makes sense? So these are all the accounting concepts. Hope you all get it. Right? And we are on the time. Praveen, can I extend for another 10 minutes or shall I continue next?
It's up to you, bro. So,
Okay. So what do you say, the other people? Dilip, Muruga, Perumal. Tanusha. Shall I continue?
Yes, sir.
All right, cool. Thank you. Okay, so we will discuss quickly the accounting errors. Tomorrow we will discuss golden rules of accounting and also like, okay, a lot of journal entries. So I think, please uh, read these concepts and remember these concepts. And these concepts are very important when you prepare a journal entries. Okay. So accounting errors. So how many types of accounting errors are there? I think, this concept needs to be told after, journal entries, but I'm telling now so that, okay, during the journal entries preparation, we will also like see like, okay, if you have the idea about these errors, you will be able to appreciate more. That's the reason I'm telling right now. So what are the different types of accounting errors? Errors, error of omission and error of commission and error of principle and compensating error. I hope you already heard these names, right? I hope you are. So what are accounting errors? Accounting errors are the mistakes made while we record the transaction or either classifying the transaction or like, okay, when we are posting the transaction in our financial statements, right? We made some mistake. So what we have different types of mistakes, as I mentioned, omission, commission, principal, and compensating error. According to these errors, how this is going to affect our trial balance or the financial statements, right? So that is what we are going to learn now. Okay. Uh, what is error of omission? Omission, again, these are definitely the interview questions. Definitions are very important. Error of omission means a transaction is completely omitted from the books. Omission means omitted, right? One day I received the electricity bill. I was very busy serving the customers and forget give the electricity bill to the accountant. Month end arrived, electricity expense is never recorded. Then the accountant asked me, uh, where is the electricity bill? Oops, I forgot. What happened? The transaction is completely missed. When it is missed, your profit is overstated. So in that case, what accountant do is like, is going to enter the expense now, right? They're saying electricity expense to electricity payable, right? So when it is completely omitted, we just need to record that transaction again during the later period because in normal MNCs, your GL accounts is to be closed. If you find before your closing of the books closing, then it will be written. Otherwise, you need to record that in the next period. So that is about the error of omission. Um, so error of omission, I have a question. Like, okay, does this error of omission is going to affect the trial balance, or is there any error comes in the trial balance? This is the question for tomorrow. So I'll just write how the trial balance affects affected by these errors, right? We will discuss this tomorrow. But just for definitions perspective, concept perspective, you need to understand error of omission means where a transaction is completely omitted, now been recorded, now been corrected. Once you enter the entry, it is corrected. Then what else we have? Error of commission. Example, uh, transaction is definition, sorry. Transaction is recorded but incorrectly. So the same example, I've given the electricity bill to the accountant whenever I received, but he wrongly recorded. If I am giving the electricity bill for 5,000 rupees, he only recorded 4,000. Right? And also I have received, I have maybe like I purchased the cricket bats from the Ramesh. I've given the invoice to the accountant, and he purchased in the Suresh account. So in this case, right, the transaction is recorded, but not in the correct account. So the first example I made, the electricity bill, right, that we should ignore. That is not error of commission. Error of commission is like, okay, you have entered the correct amount, but in the wrong account. That's called error of commission. Okay, so the next one is error of principle. What is error of principle is a transaction, again, is recorded in violation of accounting principles. Same example, I purchased the machine. So normally this needs to be recorded as fixed asset and recognize 50,000 by 5 or 10, 5,000 a month. But my accountant is recorded fully as an expense only in the current year itself, which is 50,000, right? Instead of recording it as an asset, he is recorded as an expense. So this is an error of principle. How do we correct this? We'll discuss tomorrow. Normally, what he do is expense to cash. Normally, what we need to do is like set it to cash, right? So when they already made this entry, what is the correction entry? We need to make fixed asset to that expense, right? To correct that. We will discuss more about the entries tomorrow. Now you need to only remember what are the different types of accounting errors and what are those. Error of omission, transaction is completely omitted. Error of commission, transaction is recorded but incorrectly. And error of principle is recorded in violation of the accounting principles. The last one is compensating errors, which is like two separate errors cancel each other. Here, like one error is sales overstated by 2K. Somewhere else, rent expense is overstated by 2K. What will happen? Sales increase 2,000 and the expense is also 2,000. that means if both are cancelled, right? So that's where like these are very difficult to identify. Um, so those are called when these two errors has been cancelled, then they call this compensating error. Okay, that is about accounting errors. We will discuss about we'll again like okay revise these tomorrow, and then we start the golden rules of accounting tomorrow, and also lot of journal entries will practice. I think tomorrow, please go through these concepts. There will be a questions. Please participate, right? And I think in at the last also like okay, you will be given some of the transactions. You might need to tell me the journal entries for those. Hope that is okay. So that is it for today's class. Thank you for listening, and we'll meet tomorrow.
Thank you, sir.
Thank you.
Thank you, sir. Thank you.
Bye. Bye, Praveen bro.
Yeah, okay.